because here we have, you see here, the silver squeeze inflows into SLV, which happened in early 2021, February 2021. This huge inflow here, that was all silver squeeze. But now you see this little line here compared to this all-time high here. But if we take this out, this is the highest SLV inflow since silver squeeze. The gold funds are being followed by the silver funds. Well, hello there, my friends. Rafi here from the Endgame Investor with today's weekly silver report for Arcadia Economics. Today, we're going to go into some big developments in the GLD and the SLV ETFs, the big gold and silver ETFs that had big developments this week and last. We have explosions in physical premiums in, strangely, the 40% silver junk coins for some reason. We have silver backwardation, meaning spot prices higher than futures prices for almost a week, the past 5 trading days. And finally, I want to go into a monetary issue where we have growing M2 money supply growth, meaning the amount of dollars in the US banking system growing at a rate annualized of about 12%, which is historically very high. But I suspect that most of this new monetary inflationary growth is going into consumer prices rather than stock prices, which I believe is a reason to suspect that stocks have already topped. And now it's commodities' turn, which will be led ultimately by the monetary metals. Let's get into the charts, shall we? Indeed. But before we do, I want to kindly remind our viewers that these videos would not be possible without the generous support of our sponsors, and this week's sponsor is First Majestic Silver. This is where I do buy my physical silver coins. I have stacks of them from First Majestic, and they are beautiful. You can go to the First Majestic Silver store at store.firstmajestic.com. And it also is a pretty good indicator of where the premiums are for physical silver. If you ever want to check it in real time, the full ounce silver rounds at 20 per tube are being sold at $27 per ounce. Plus, news for Q4 2021, and these press releases can sound complicated, but they're really pretty simple. The gist of it is that First Majestic has had the best quarter ever in terms of production at 8.6 million ounces of silver for Q4 2021. This is a quarterly record, plus 67,411 ounces of gold, which is a 17% increase compared to the prior quarter. The reason that I hold silver mining stocks, in addition to actual bullion, is that when the SHTF, and eventually it will, these are the only companies that will be able to pay consistent dividends that have actual value, whether that be in certificates of some of the product that they dig out of the ground, or they even mail shareholders a portion of the gold and silver that they dig out of the ground. This sounds crazy now, but when the dollar is in collapse, it's going to be very important to earn real dividends from your companies, because otherwise, what is the purpose of holding stocks? So this is the ultimate purpose of holding mining stocks, not necessarily the capital gains in dollar terms or whatever fiat currency terms you want to count in, but if you want a stable income, they have the ability to pay shareholders in real gold and silver dividends, whether that be in certificates that they store the silver for you. Gold and silver miners with real product would be able to send their shareholders real dividends. And this is the ultimate purpose for holding these stocks. Don't be confused. Now let's get into the silver charts for this week. First, most significantly this week, and I know that this is a silver report, but this is critical. GLD, the main and biggest gold ETF, has increased its holdings by its most in dollar terms in history last week. In gold terms, I think it is the 11th or 12th biggest inflow in GLD in its history. You can see here, this bottom chart of these lines, these are daily inflows. This big line here, higher, is about 930,000 ounces, almost 1 million ounces of gold inflowing into the ETF in 1 week. Now, if we look historically, this is the second biggest inflow in ounces terms since May, June, looks like May 2019. That was right here where my arrow is circling. This was the big breakout from the 6-year trading range that eventually brought gold up to its all-time highs, and silver followed to around 30. So these inflows are typically a signal of a major trend change. And here we have the closing triangle in gold that has been in process since the highs. And so it is likely that what we are seeing here is a final breakout of this triangle consolidation, which will be followed by silver. What will trigger it? Perhaps an inflation report, a CPI inflation report that is way above expectations, while the Fed is perceived to be chasing inflation higher by tapering and raising interest rates. And when the market sees that this is not working, the metals will break out. We are getting close. Next chart. The gold ETF is being followed by the silver ETF, not as extremely, because here we have, you see here, the silver squeeze inflows into SLV, which happened in early 2021, February 2021. This huge inflow here, that was all silver squeeze. But now you see this little line here compared to this all-time high here. But if we take this out, this is the highest SLV inflow since silver squeeze. The gold funds are being followed by the silver funds, which means that investment interest in paper, gold, and silver, which I know is not ideal, but it is a signal, is increasing as the silver price has been falling steadily. Now, this surprised me. I took a look at premiums. Junk silver premiums, which gives you an idea of the price of pure silver, taking out any numismatic value or strange supply issue value like in Silver Eagles, where the supply is not very reliable. So here you have a sudden increase in 40% junk silver premiums right at the beginning of 2022. Why is that? How did that happen? What is going on here? My theory is that this has to do with consumer price inflation again. In 2022, it looks like companies or bullion stores on the street have increased their prices for 40% junk silver premiums. This is the cheapest kind of silver you can buy. So it is poor man's silver, even cheaper than 90% silver junk. And the fact that premiums have skyrocketed at the beginning of 22 probably means that stores are resetting their prices higher, which means that the price of silver is climbing with inflation, as it should. Next, this is a small cutout of a chart of settlement prices for silver. This was yesterday, June 25th. It settled January 2022 is spot silver for immediate delivery, settled at the same price as February 2022 for February delivery. This is just one chart, but spot silver has been trading higher than February futures for about 5 days prior to this, for about a week, which is a very long time for silver to stay in slight backwardation. It is not extreme, but it is a signal that physical supplies are tight. The final chart that I want to go into is a monetary point. And this illustrates basically how the Fed is pretty much screwed. The bottom chart is a calculation of the annualized rate of growth of the money supply on a quarterly basis. So basically, you take the quarterly average of the money supply, the total money in all banks in the United States, and you multiply that by 4, and you get an annualized rate of growth. Here, you see the COVID era, up to 50% annualized monetary growth. That is hyperinflation in a monetary sense. Now, there's two things about this chart other than that I want to focus on. First is this area right here where it says 0%. If it goes below, if the growth rate goes below 0%, that means the money supply is shrinking in absolute terms on a quarterly annualized basis. This happened in September 2008, right here where the arrow is circling. That led to a stock market crash, which the Fed responded to by printing at a nearly 20% monetary increase rate. That was a record at that point. Here we have the market forces trying to deflate the money supply again, but stocks did not crash here because they had already crashed here and prices were already much lower than they were prior to this. However, there was another crash around 2015, August 2015 here, when the monetary growth rate went to zero again. That was the crash of Black Monday, August 2015. Now, we are here at about 12.3%, and this is historically a very high rate of monetary growth. So the question is, at that rate of extremely high monetary growth, why are stocks crashing? And the answer, I believe, is up here. This is the quarterly number, the quarterly amount of federal transfer payments, meaning checks that go from the federal government directly into consumer checking accounts. If you look at these crazy spikes here, this is, of course, the COVID era. Now, if you calculate how much more over the trend that transfer payments have been since March 2020, the answer is 8 trillion more. So $8 trillion of the money supply has gone from bank reserves to consumer checking accounts. And much more money in the consumer sector of the economy is going to go into consumer prices than say money that's stuck in banks, which will almost all of it go into asset prices, stocks, bonds, and real estate, etc. But when you send all this money to consumers, it will go, much more of it, into consumer prices. Some of it will go into stocks, yes. But now the point is that the monetary growth rate of 12%, with so much of it going into directly consumer checking accounts, it's going to chase consumer prices higher. So at this point, in this historical era in 2008 until 2020, higher money supply growth meant more money for banks that they could plow into assets, which meant stocks would rise. But here, a higher money supply growth rate reflects a lot more money being sent to consumer checking accounts who spend it on food and groceries and rent, etc. So at this point, a higher money supply growth rate will mean higher consumer prices, which means that even though the money supply is growing, stocks may have already topped. And once the market figures this out, more and more money will head into the gold and silver sector, led by silver, because this is a consumer-led spiral. In the end, my friends, the story is this: the Fed is publicly chasing inflation now. The next two CPI and PCE inflation reports are going to be critical, because once the market sees that these moves to hike rates and to taper are not doing anything to actually taper consumer prices, the market is going to clamor for more action by the Fed on inflation by doing what? By raising consumer prices and the prices of gold and silver even more, and daring them to taper even faster and to raise interest rates even faster. And once the market sees that even that will not help, they will bid gold and silver and consumer prices even higher than that, and the chase will start to spiral. We are, I believe, months away from the meat of this happening. All that is required is a little more patience, and it has been extremely frustrating, and that is good, because that means the weak hands will be filtered out. But we already see the prices of bubble stocks and cryptocurrencies are already falling, and gold and silver are still heading higher. This is Rafi, the Income Investor, coming at you with this week's Silver Report for Arcadia Economics. And I wish you a great week of stacking and stability, and of course, sanity. See you next week.